Hello there, and welcome to today's forecast looking at the Aussie dollar versus the US dollar currency pair. The exchange rate is fluctuating at around a 4-year low, strengthening after the release of positive domestic data. With more unemployment data out today and the interest rate staying put for now, I am joined by Robert Rennie of Westpac in Sydney to discuss how the pair will develop. Hello, Robert. Could you tell me your short and mid-term predictions and the reasons behind them?
In terms of our near-term forecasts, what we think we'll see tomorrow is that recent data will obviously be revised potentially very significantly as a result of false seasonal adjustment factors. We were expecting a drop in employment of 70,000 following up from the recent 121,000 rise. With that more than likely to be removed from the employment data, we now expect the employment numbers to increase in the month of September by as much as 30,000. I think the best thing to do is look through the recent volatility and obviously the statistical disruption, and the underlying picture is that we're beginning to see some signs of improvement in the jobs data, and that would be annual employment increasing from about 1.25% to somewhere between 1.5% and 1.75%, and we're also likely to see an unemployment rate that's peaking in the late fives, early 60s, and we would expect as we move through the rest of this year to see modest continued signs of improvement. In terms of the near-term forecast for the Australian dollar, look, there's a number of factors there. One is we expect to see some improvement in the commodity story through the end of the year in China. We're moving into a period of increased demand, stock rebuilding. That's something that should hold iron ore prices and possibly see some improvement into the end of the year. So that, from our point of view, is a positive. We also continue to see signs of ongoing demand for longer-term investors in the Australian dollar, and one of those today was Japanese MOF data, which continued to show fairly aggressive demand for Australian dollars from Japanese investors. And I think it's that sense of stability that argues, from our point of view, that we should see Aussie back towards 90 by the end of the year.
Finally, how do you see the currency pair playing out in the long term?
Look, there's a number of factors that drive that. One is obviously getting the right timing between the RBA raising rates and the Fed raising rates. Clearly, there's a great deal of debate in financial markets as to when the Fed will first raise rates. Less so from an RBA point of view. Look, we're expecting the RBA to raise rates next year in August. By the end of the year, the RBA will have raised rates from 2.5% to 3%. From a Fed point of view, we have the Fed adjusting rates in the third quarter of next year, taking the Fed funds rate up from 12.5 basis points to 25 basis points, and then ultimately 50 basis points by the end of the year. It's the fact that we've got a widening in the yield spread in favor of the Australian dollar that drives our forecast for a higher Aussie by the end of next year. It's also the commodity story as well. What we have to remember as we move through the end of this year, the first of the major gas projects, the LNG export projects, will come online. That's the QCLNG project run by BG. Then as we wander through mid-next year, APLNG, GLNG, and Gorgon, another 3 major gas projects will come on stream round about mid-year. That starts to have a material impact in the trade position here in Australia and starts to see increasing trade surplus as we move through the second half of next year. Those are the factors that lead us to expect to see strength, not weakness, in the Australian dollar through the latter stages of next year.
Thanks, Robert. Stick with Dukascopy throughout the day for more news. Goodbye.